My name is Lowell Walters, and I'm grateful for the opportunity to speak to you today about some timely employee benefits issues that I think you should know about. Now, the focus of my practice is employee benefits. I know that that's not the case for most of you, but I think this presentation is going to strike a balance between if you do employee benefits most of the time, you'll learn something new or maybe get some questions answered that you had. If you don't do employee benefits on a full-time basis or even on a part-time basis, it might be helpful for you to understand what's going on in our world. And hopefully I'll hit upon several things of interest to you. Now, in particular, I want to talk about how in these times when organizations are struggling, you can reduce certain company costs with employee benefit plans. I also then want to touch on how retirement plans and certain issues that are arising in this unstable financial market. And let me just say, I'm an attorney. I am not a financial advisor. Okay, so I am not giving financial advice. Sometimes I think it can be helpful for me to talk about financial issues that retirement plans face, in part because I know the legal requirements, but that I don't know the financial requirements. And like most of you who may have to make financial decisions for your retirement plans, I would rely on advice from my advisors and what have you. So keep in mind, I'm not giving financial advice. I guess technically I should say, in this kind of presentation, I'm giving general information, general legal information. I'm not giving out specific legal advice either, but there you go. And then I'm going to wrap up by talking about hours reductions and how it's affecting health plan eligibility and also COBRA eligibility. So first, I want to make clear that you can reduce your organization's costs if you structure your employee benefit programs properly. And the way you really accomplish that is that you use your healthcare and retirement benefits as a form of compensation, all right? And you eliminate employment taxes. Now, compensation that we pay to our employees is subject to employment taxes. It's about 15%, with 7.5% coming out of what should be going or what would normally otherwise go to our employees, and another about 7.5% coming out of our organization's general fund, all right? So amounts that we pay for our employees towards healthcare benefits or employer contributions that we make for our employees' benefit into qualified retirement plans are not subject to these employment taxes. And this can yield some significant savings. Just to put this into perspective, right? For every $1,000 that you would normally pay to an employee, if you're able to redirect that into some sort of medical benefit or a retirement plan contribution, all right, that saves overall $150. About $75 is saved by the company, about $75 is saved by the employee. So it can build up, and it's truly a win-win. Now, probably the easiest way to make use of this opportunity is to redirect bonus payments. Bonus payments, or maybe other payments that aren't part of regular payroll. It tends to be the easiest thing to explain to employees, to say, normally we give out a year-end bonus. Instead, we're going to put your year-end bonus into your 401k plan, and you can use the distribution features to access that if you need to. Now, keep in mind, if you are going to do that, putting it into a retirement plan, make sure, check with your plan administrator, your third-party administrator, or your record keeper to make sure that's not going to hurt your non-discrimination testing. In a lot of organizations, the people getting bonuses are the higher ranking employees. So if those are the only ones getting a retirement plan contribution, that could be an issue. Now, again, this opportunity is not limited to bonuses, and it's not limited to compensation that's outside of regular payroll. You can do it with straight regular salary, hourly paid employees, but it's just a little bit more difficult, a little bit harder to explain. Another thing that's going on in the current environment is a lot of organizations have reduced the contributions that they are making to their retirement plans. All right, they may have said, maybe announced last year December, hey, we plan to make a 10% contribution to the plan on your behalf, a 5% contribution to the plan on your behalf, and then maybe May, June, they said, you know what, with the way things are going, we can't guarantee we're going to make that contribution, right? Or maybe the plan was a safe harbor plan. Safe harbor plans guarantee a minimum level of benefits to the employees, and maybe your organization had to go through and pass an amendment to remove that safe harbor status, which you're allowed to do if you're encountering financial problems, all right? Now, if you do that, then you've already saved money because your contributions to the plan have been reduced. Now, if you are concerned about some of your executives, some of your higher level employees, now they're not getting the retirement plan contributions they were expecting, you actually can use a non-qualified plan to provide similar benefits just to those employees. All right. For example, I had said before about maybe you were going to make a 10% employer contribution and you decided you need to cut that down to 3%. Well, for this smaller group of employees, you can make a 7% contribution to a non-qualified plan. Maybe you were a safe harbor plan doing a safe harbor match and you've gotten rid of that. Well, you can actually look at someone's 401k or 403b salary deferrals and make a match to a small group of employees, make a match not into that 401k or 403b plan, but make it to a non-qualified plan. So similarly, maybe again, because maybe you were safe harbor and you did away with it, and soon you're going to realize that the reason you were safe harbor is because without that protection, your higher ranking employees can't salary defer what they wanted, or you're going to fail non-discrimination testing on your employer contributions. And the normal way to correct that is to remove those contributions from your high ranking employees. If that's your situation, again, the amounts that won't fit into your 401k plan or won't fit into your 403b plan because of non-discrimination testing, you can have those, instead of those benefits being lost, you can have those benefits pour into a non-qualified deferred compensation plan. Now, the benefit to these non-qualified plans, all right, is that they allow disproportionate benefits to your highly compensated employees, but there are some drawbacks, all right? And these are drawbacks I'm talking from the employee's perspective, and they're important to be aware of as you're communicating with those employees. Number one, there are more limited, or more, I shouldn't say limited, I should say restrictive. It's more restrictive distribution options. If you think about your 401k, 403b plan, most of them are probably worded to say, once you hit age 59 and a half, you can take a lump sum distribution, you can take installments, you can take a series of other payments. You just let us know when you want the money. And that's it. That's kind of like your standard 401k, 403b distribution wording, all right? With non-qualified plans, if you're putting in funds, you're making a 2020 election, this would be for funds going in 2021, you need to decide right now how that money is going to be paid out and when. Normally, it's a lump sum on severance of employment, but it could be after a set number of years or what have you. So you do have options, but you kind of need to lock them in right at the start. Another drawback that it's important your employees know about is there is no rollover opportunity. Unlike a 401k, 403b plan, when the employee leaves, they can roll those funds into an IRA or another plan. Here, once they are entitled to receive those funds, it's taxable and you can't roll it into another plan or an IRA. The other drawback is that these amounts are subject to employment taxes. Right? In my last slide, I talked about saving money by putting more money into a qualified retirement plan, all right? Now we're talking about saving money by making your contributions to a smaller group of people. So it's a smaller group of people, but the amounts would be subject to employment taxes. So you would not enjoy that savings. And then any amounts put into these non-qualified plans, those assets are potentially subject to the claims of your organization's creditors. So if your organization is on unsteady footing financially, that could be a concern for the employees you're looking to benefit. Now, again, if you have any questions about anything I've said, please go ahead and speak up. Otherwise, I'm going to move on to talk about retirement plans in the current market, right? The current stock market has been inconsistent. My understanding is that there will continue to be, well, I guess there's always ups and downs, right? But my understanding is that there will continue to be this inconsistency. Now, unfortunately, there was a combination of things that happened last spring, right? The stock market totally tanked, and at the same time, a lot of employees lost hours or otherwise lost income, and they viewed the 401k plan as a way to replace that lost income. So, you know, in general, removing it from the 401k plan in a down market is one of the worst things you can do, because you recognize those losses. The money is then no longer in the 401k plan to ride back up when the market goes back up. But that's the situation our employees have been in. Combine that with, we did get guidance in the spring creating what we call coronavirus-related loans, coronavirus-related distributions. This was a rule that actually made it easier for our employees to access the 401k plan in that down market. So, you know, financially, it tends to be a bad decision, but if they need the money, they were given the opportunity to access that money. And now a lot of them their 401k plan could be in very bad shape. Fortunately, we did get guidance from the Department of Labor on individualized investment advice, which is something that most qualified retirement plans have shied away from. I'll talk about why in a moment. We also got Department of Labor guidance on using private equity investments in defined contribution plans. Now, private equity investments is something that's very complicated. It's not something that I can necessarily speak on with authority. However, there is a segment of the population, I know a segment of this organization, where there's a high number of these kinds of employees that consider themselves to be investment professionals. And I'm talking about physicians. Physicians often have a chance to look at the market, study the market, and I envision that group of employees as being the kind to hear about this guidance and want to talk to their organizations about allowing private equity investments. So I want to talk about that. Now, with coronavirus-related loans and distributions, I'm not going to give a rundown of the requirements. This, not to say that it's old news, but it is news that is maybe 3-4 months old. Information about them is widely available. But there are just a couple of key points I want to touch on. Number one, it's optional, all right? If your organization is struggling about whether to allow these loans or distributions, just keep in mind, you don't have to allow them. It is optional. That being said, every plan that I work with is offering these loans and distributions, the idea being if their employees need the money, they want them to be able to access it, even if it might not be a good financial decision. Now here on your sheet is some notes I made about who's eligible for these loans and distributions and the limits. It's here. It is available elsewhere on the web. It's not something that I'm really going to talk to you about, but you're welcome to ask me questions if you have them. Now, I can't stress enough that if you have an employee that is kind of going back and forth, do I want to take a loan? Do I want to take a distribution? I can't stress enough, you do not want to make that decision for them. That is their decision, not yours. But just for the sake of talking, for the purpose of this conversation, you know, I have thought through it. And in my mind, I think that for most people that are struggling with which option to take, it's really going to come down to whether they expect or want to repay the amounts they're taking, all right? Both, you know, plan loans do get repaid, just like all loans are supposed to be repaid. But coronavirus-related distributions have a repayment option. It's not required, but it's optional, right? So If the employee really intends to repay that money, then using a loan might be easier. You repay it through payroll deduction, which is the easiest way to repay a loan. And you can repay it over a longer period of time, which means smaller regular repayments. It's certainly the most convenient way to repay money. On the other hand, if you're not sure that you want to repay the money, well, the distribution allows you to not repay it. Plus, if you're under age 59 and a half, the coronavirus-related distribution is exempt from the 10% penalty, which is a nice benefit. If you were to take out a loan and in a year or two you default on that loan, that's treated as a distribution, and that distribution would normally be subject to the 10% penalty, so you could actually wind up being worse off. So just some food for thought. Again, you don't want to make this decision for your employees, but potentially if you know they're struggling, you might want to steer them in, hey, why don't you look at the differences with repaying those amounts if that's a consideration. All right, investment advice. You know, I think we all know that investment advice helps our participants invest properly. And in this environment, with the losses that many participants have suffered, it can be more important now than ever, all right? We've always known that providing generic employee education is a safe way to do it, and that's what most plans offer, just generic employee education where the employee can log in, answer some questions, get an indication of whether they're a moderate investor, a risky investor, what have you. But, you know, providing individualized advice, retirement plans have really shied away from doing that. And that's because of certain concerns, like how can the plan know that the advisor is acting in the participant's best interest instead of the advisor's best interests, all right? That's a real concern. Now, if the advisor is a plan fiduciary, right, historically, if the advisor would take on fiduciary responsibility, that would give the plan some comfort. But there actually is a concern about paying fiduciaries from plan assets. So, you know, plan assets is really how plans pay for a lot of their expenses. So that was a potential problem. On the other hand, if the advisor was not a fiduciary, right, then participants wouldn't necessarily have a right to sue the advisor if they got bad advice. They would have to sue their employer on the basis that the employer did a bad job hiring their investment advisor. So very few plans offered individual investment advice. Some examples of the particular problems that I've seen myself is where an advisor clearly was getting some pressure or some internal incentives to recommend certain investments to their customers, and they weren't necessarily in the employee's best interest, they were in the advisor's best interest. Similarly, we've seen situations where participants have gotten individual advice, and what the advisor says is, you know, you're 59 and a half, you can roll this money out into an IRA, and that will give us more investment flexibility. And they talked about the flexibility. What they don't talk about is how in the plan, the investments often qualify for institutional-based fees, almost like wholesale fees, whereas it's higher fees on investments made through the IRA. They also fail to inform these participants that if they do roll their assets over into an IRA, that money is no longer available for loans, which may be useful. And then I also encountered a very unhappy participant who had rolled their funds over and their only retirement money, right, was in the plan. They didn't have their own IRA before, and they were absolutely shocked that the year after they rolled their money into an IRA, they got a notice that required minimum distributions were required. Because while money's in a 401k plan, an active employee, no matter how old they are, is not required to take their required minimum distributions. Once the money's in an IRA, those obligations do kick in at age 70 and a half. So there were definite problems before, and the Department of Labor gave us a solution. This is very nice. We can now hire a fiduciary, and if that fiduciary complies with the DOL requirements, they can be paid from plan assets. It solves solves all the problems that I've talked about, really. Now, I'm not going to go through all the steps to hiring a fiduciary, just a couple of key points I want to mention. For a long time, in a lot of areas, the Department of Labor wants plan sponsors to assess conflicts of interest. And actually, this is good advice, really, for anybody engaging any professional. Even if any of you have a financial planner, all right, assess the conflicts of interest. I actually recently was helping, not related to retirement plan, but we're talking about investments, and I asked the advisor, do you make more money depending on what we invest in? And I got an answer that made me comfortable, but that's a question you should be asking. Now, for this purpose, investment advice fiduciaries, the DOL made it really very simple. Investment advice fiduciaries are required to have written procedures to help them avoid and address conflicts. So rather than try to ask the right questions to uncover a potential conflict of interest, where else do you make money other than the plan or what have you, you can simply say, may I see a copy of your written procedures to avoid or address conflicts? All right, very nice, very easy. Then there's some requirements that the contract must have. Again, I'm not going to go into that now, but there are certain requirements the contract must have. And then you need to confirm that the compensation that you're paying this fiduciary is reasonable. Now, most retirement plans have an investment advisor that helps the employer select what investments to offer in the plan. And that advisor, part of their job is usually also making sure that the fees being charged are reasonable. So if that advisor is going to be a different person from the investment fiduciary advisor, the investment advice fiduciary, then that advisor who assesses all your other fees can probably assess this fee as well. Let's see. So now I want to talk about private equity investments. The Department of Labor issued guidance specifically on private equity investments. However, looking at this, my opinion is that this guidance is actually very helpful when you're considering any, I'll call it alternate 401k or 403b investment. Now, the Department of Labor guidance, right, they're focused on private equity, which generally is investments in non-publicly traded, publicly traded companies. There is a higher risk of loss, but I think that investing in multiple entities mitigates that risk, at least that's what you hope. And in general, the idea is money is going to sit there for a while longer than a normal standard investment where you can be in and out. Although frankly, with retirement plan investments in general, being in and then out is not usually the way you want to go. But the Department of Labor explained that even if this investment is more risky, it can be used by retirement plans if the plan sponsor's fiduciary obligations are fulfilled. Now, keep in mind, actually, a funny coincidence. I have to think it's more than a coincidence. Within a month, I forget if it was a month before, a month after, but within a month of the Department of Labor issuing this guidance, the SEC issued guidance saying that they happen to review and investigate private equity type arrangements in general and find that a lot of them have confusing commission structures and that it seems to be unfairly difficult to uncover potential conflicts of interest and to understand the payment structures. So fair warning to anybody looking to do this. Certainly you would not use a private equity investment or private equity investment related investment in your retirement plan without getting retirement plan advice. All right, certainly you would not want to do that on your own. But again, this guidance can be helpful still, even if you have no interest in going to that level of complexity. This guidance really should be helpful in helping you think about any kind of alternative investments. And a lot of times when you talk about alternative investments, that's done through what we call a brokerage window. You have your set of funds in the retirement plan, and then you have a window, and by going in through that window, kind of opens things up. And windows have been used by people for individual stocks, to invest in collectibles, to invest in real estate. I suspect that that windows are being used by some people to invest in cryptocurrency. Anything out of the ordinary like that. This guidance by the Department of Labor talking about how we should be thinking can really be useful. So again, I'm not going to go into the finer details, but just hitting the main issues and explaining them. Anytime, if you're thinking about rolling out a new investment, a new type of investment, think first, all right? How will this affect general plan operations? And the bullet points underneath are just an example. Retirement plans, for example, need to have liquidity or be able to convert illiquid assets to cash to make distributions, to make loans, what have you. Will this investment help that, hurt that, or be neutral? Is it a proper plan investment in light of our employee population? That's a part of the thought process you should go into when thinking about a new type of investment. Will this new investment make it harder for us to comply with our reporting requirements? And when I say reporting requirements, I mainly mean the 5500, which generally requires you to disclose the value of your assets and where those assets are. So how will this investment impact your ability to do that job? And the risk of conflicts, all right? You need to be able to assess the risk of conflicts, who's going to benefit from this, who stands to gain, who stands to lose, is it fair? So those are my comments on the retirement plan side. Seeming if there's no questions, I'm gonna move on to the last topic I wanna cover, which is reductions in hours, health plan eligibility, and COBRA. So, you know, we have coronavirus-related leave. We have employees on coronavirus-related leave. We have employees that we've had to terminate their employment, or maybe they've severed employment themselves. We have employees that have gone on, that have been furloughed. We have employees on temporary severance. We have employees who have had their hours reduced, and probably a whole bunch of other names for things that I'm forgetting or maybe don't even know about. The fact is, when talking about your health plan's eligibility, don't focus on what you're calling it. Focus on what hours are being worked and what does your health plan say with respect to eligibility. Now, especially because of the Affordable Care Act generally says if an individual is expected to work at least 30 hours a week or at least 130 hours a month, then they should be eligible for health insurance coverage. Because of that, most of our plans describe eligibility in terms of active employee, former employee, and in terms of hours, normally using the 30-hour threshold. Back in the day, it was a lot more classification based. Employees classified as X were in the plan, employees classified as Y were out of the plan. And some plans still talk in terms of full-time, part-time, just hopefully they have defined it properly. And in the medical field, you have per diem employees, and a lot of times health plans will reference per diem. I will say, regardless of that reference, that 30-hour threshold is an important one for general compliance. But so anyway, look at how your health plan describes eligibility in terms of hours and classification. And then you need to understand how your company assesses that 30-hour threshold. Does it conduct a monthly prospective assessment on hours it expects this employee to work in the future? All right. Or does it use a look back measurement period? All right. Does it look back at the hours worked in the prior year, and based on that assessment, someone will be eligible or ineligible for the next year? It's important to understand that, and that is not always written into the cafeteria plan. All right. It does not have to be, but you need to know what your company is doing. Now, add to the mix that based on some special COVID-19 related guidance, your plan can allow participants to make cafeteria plan election changes in 2020. Normally, in the middle of a plan year, you've gone through open enrollment, you can't change those elections or make new elections unless you've had a child, had a divorce, some sort of a life cycle event like that. However, at your organization's option, you could be allowing employees to come in and make all new election, dropping coverage, adding coverage, changing tiers, what have you. So this does add to the complexity of who's eligible, who's not eligible, and when someone is no longer eligible, is it subject to COBRA? So let's talk about that, all right? And the idea, let's keep it basic. Why was eligibility lost? All right, take a look at that. Why did someone lose health insurance? If it was because their employment ended, they are working 0 hours and you don't know when they're going to start working again, that's a COBRA event. If it's that their hours have been reduced below the threshold, so they are no longer eligible because of reduced hours, that generally is a COBRA event. If their hours were reduced, right, but they're still eligible for the plan, they didn't lose plan coverage, but that reduction in hours led to a reduction in income, and that reduced income meant they couldn't pay their premiums anymore, and they lost coverage because of a failure to pay premiums, that is not a COBRA event. And mind you, that actually really does make sense. I mean, it's certainly unfortunate, but if these employees couldn't afford to pay their premiums while the company was paying its share, odds are they wouldn't be able to afford their premiums when the company didn't have to pay its share on COBRA. So there is logic to that. If a participant did a COVID-19 related election change and dropped coverage for himself, for his or her spouse, those individuals, that is also not a COBRA event. So you don't need to generate a COBRA notice for that. Now, keep in mind, to the extent you do need to issue a COBRA notice, we have COVID-19 guidance that changes that. In particular, what the COVID-19 guidance did is it extended the time frame someone has to affirmatively elect to accept COBRA coverage, and delayed the time frame for them to make their payment of COBRA premiums. Technically, we're in this kind of indefinite delay right now, all right? The delay will last until 60 days after they announce the end of the COVID-19 emergency, all right? So let me back up for a second. Now, so this means that if you haven't updated your COBRA notice, you probably should do so, because standard COBRA notices, say you have until this date to make your COBRA election, and you have until this date to pay your premiums, and then premiums will be due on this time, every month. And right now we're in a period of time where that is not valid. All right. I will say the Department of Labor made things actually worse. I was happy with their guidance we talked about earlier today. I was not happy when I saw their updated COBRA notice, because their updated COBRA notice doesn't account for this. So if you're sending out the COBRA notice that the Department of Labor created as their sample, you're giving your former employees or your employees who lost health insurance, you're giving them bad information. All right? And I would strongly recommend that you update that COBRA notice to get those individuals the right information. Because if you do this wrong, there is potential risks, potential liabilities, all right? Now, if you offered COBRA to some people you didn't need to, right? Maybe an employee came in, made a COVID-related election to drop coverage for their spouse, so you offered coverage, you extended COBRA coverage to the spouse, they actually accepted it. You're not gonna suffer a penalty from that because you didn't hurt somebody, and you can remove that spouse, you can remove that person from COBRA. Just need to do it carefully. You need to provide them notice. You can't just say, effective Tuesday, your coverage is gone because you weren't supposed to be covered anyway. You can't do it like that. However, the problem comes if you fail to offer COBRA to the proper individuals, or you didn't offer them the right coverage. So just for example, maybe you didn't update your COBRA notice as you should have. So your former employee got the notice and it said that they have until a certain date to elect it, and they need to pay by a certain date. And with their financial situation, they figured, you know what, I better not elect. And then they find out that that was wrong. They actually had more time, right? Potentially, the two risks, number one, there is a risk of a $110 per day penalty, and that's $110 per day per affected participant. So, you have a layoff of 50 employees, 20 employees, 100 employees. They all get their own COBRA notice. Each of those employees, $110 a day, it adds up, all right? The other potential risk is that if those individuals go and incur medical expenses that should have been covered under your group health plan, they can seek coverage for those. Now, if you have commercial insurance, technically those individuals were not enrolled. Technically, they didn't pay premiums. So your insurance company can actually say, hey, they're not covered under our policy. And what would actually happen is, because it was an employer mistake, the employer would need to self-insure those benefits. Now, a lot of you out there may have self-insured plans, and you're like, well, we self-insure anyway, so no biggie. To a certain extent, that's true. For the most case, that's true. Well, for the most part, that's true. However, even self-insured plans use commercial stop-loss coverage for claims that get really big. And again, potentially the stop-loss provider could say, sorry, this person was not properly covered under the plan, so they're not our responsibility. So your organization would not have the benefit of stop-loss for those participants. And what's more, as you might know, people who come in without insurance, they're not subject to the negotiated rate for medical services. So technically, these employees or former employees will be getting coverage outside of the plan, so the medical providers aren't bound by that negotiated rate. So there can be some significant liabilities, important to be aware of those. So let's see, I think those were the topics I want to talk about today. I'm going to go and stop my recording.